Hi, everyone. I'm Stephanie Link with Torsten Slok today at a special webinar. Torsten, as you all know, he is very popular and he is one of the best on Wall Street. He is the partner and chief economist at Apollo. He has been there since 2020. But before that, that's when he and I met. 15 years he was on the sell side. He was number one II analyst and team, not only for fixed income, but also equities for 10 years, which is really astounding. So congrats on that. He was also part of the OECD, the IMF, and he has published a number of journals and on economics as well as policy. And we're delighted to have you, Torsten.
Thanks, Steph. Thanks for having me. I look forward to
So,
it.
so the whole reason that we're doing this is because you and I met at CNBC in the green room 3 weeks ago, and I asked you how you were feeling, and you had a smile on your face, and you were feeling really good, and I was just like, wow, that's worth exploring. So, talk to us a little bit about what you're thinking overall about the economy and all that is going on. We'll get into a lot of different subsets, but just give us your overview to start.
Yeah. So let me share my screen and show you a few pictures and give, as you say, just a slight, briefly summarize how we look at things at the moment. What's remarkable, if we look at the economic situation at the moment, is really how well the economy is doing. There's a lot of headwinds obviously coming from the Middle East. Gas prices have gone up. There's a lot of uncertainty. But when you then go and look at surveys for consumers, they say, wow, things are really bad. There's daily data for low income, middle income, high income consumers that actually sends very, very negative signals. But there's a major difference, as you can see in this chart here, between what people are saying and what they're actually doing. This chart shows you the weekly data for same-store retail sales. That means every week, Redbook goes out and asks Walmart, Target, TJ Maxx, the other retailers, what were your sales last week compared to the same week a year ago? And as you can see, when the conflict began in February, there's really not much sign of things slowing down. Consumers are still spending. Similarly, if you look at the daily data for how many people travel on airplanes, this is the TSA data. The red line shows you for 2026. Yesterday, as we speak, about 2.5 million people scanned their boarding pass with a TSA agent in the US. But look at the path in this daily data over the last 2 months since the conflict began. And you can see it's basically followed the same path as 2024 and 25. So despite the mess that we've had with the TSA, you still see people traveling on airplanes. It was not the case that people were canceling their spring breaks. Instead, leisure travel is still strong, business travel is still strong. If you also look at hotels, same story. This is weekly data from a company called Star. Every Thursday at 9 a.m., they publish data for the occupancy rate, which is what you see in the red line, the average daily rate in the blue line, and RevPAR, meaning revenue per available room in the green line, also not showing signs of any slowdown. And finally, if you take the overall Fed's weekly GDP indicator, this is the green line here. Again, the conflict began in February. There's really not much signs of things slowing down. And why is it that the economy continues to do so well? Well, that's because we have three very important engines of growth. We have an AI boom. We have a very significant boom in data center spending, very significant boom in energy associated with data centers. We also have productivity gains coming from AI. We calculate that the AI spending will add about 1 percentage point to GDP growth. And remember, GDP normally grows at 2. So that means that roughly half of growth this year is going to come from AI spending alone. We also have industrial renaissance, meaning the home shoring of production of semiconductors, of prescription drugs, of defense. And finally, we also have the One Big Beautiful Bill, which is also an important tailwind. Remember, One Big Bill lowered taxes retroactively starting January 1, 2025. The Congressional Budget Office estimate One Big Beautiful Bill will add about also 1 percentage point to GDP growth. So taken together, the bottom line to your question, Steph, is that if you ask me how is the economy doing, it's not surprising that the economy and earnings in this week is very important from an earnings perspective. You know this better than me. This is really critical. And this is when we're figuring out there's some very strong tailwinds from AI, the industrial renaissance, and the One Big Beautiful Bill. So we should expect to see earnings still be solid. We should expect to see growth. And for that matter, also inflation still remains to be solid.
Why do you think there is such a disconnect? I've never been able to get this answer myself, but why do you think there's such a disconnect between the sentiment surveys and the way people are talking to the actual spend itself? Because I've witnessed that as well. I've always ignored the sentiment surveys because there's just no correlation. But why do you think that is?
Yeah, this is very important. But I think papers who have looked at that question, just look at the latest data. This is daily data from Morning Consult. And they show in the green line, this is the daily data for consumer confidence for low-income households. The orange line is consumer confidence for middle-income households. And the light blue line is consumer confidence for high-income households. And as you can see in the vertical line, since the conflict began in the Middle East, it's absolutely clear that all these lines have gone down. So there are two reasons why these lines move around. Number one is gas prices. I know it sounds very primitive, but that is the case. People put a lot of weight on what is the price of filling gas on my car. And most people have an idea about, does it cost about $50? Does it cost $80? Does it cost $100? And that number, when you begin to look at this, especially as much oil price have moved recently, this is often a sticker shock that people have some idea about whether oil prices are a lot higher or a lot lower, and therefore end up saying, wow, it's more expensive or less expensive than it used to be. The second thing that also drives this around, and you see that a little bit in this chart here, is the stock market. The blue line for high-income households, people making more than $100,000, it did go down when the conflict began. But look at the last 2 weeks. We've started to see it again begin to at least stabilize a bit more, at least more than the orange and the green line. So the answer to your question is that you're right. Everyone should really ignore the consumer confidence indicators, at least from the market perspective, and should just think of this as either gas prices are going up or down, or the stock market is going up or down. And those are the two main inputs that people have on their minds. Low-income households mainly worry about gas prices. High-income households mainly worry about stock prices. And that's what's driving around these sentiment indicators about how people feel about the economy at the moment.
And the K-shaped recovery, because not only does the upper income consumer have exposure to the markets, they also have a house, most likely, and home prices we know over the years have actually gone higher. Is that right?
That's absolutely right. And that's also why when you look at that exact issue, that has only, of course, continued on the relative different legs of the K. The K, of course, is an illustration that the upper leg of the K is the high-income households and the lower leg of the K is the low-income households. And this chart here illustrates that point very clearly. This shows you savings across the income distribution. If you look to the left, these are households that make less than $25,000 a year. What were their savings cumulatively as a group in 2019? And what are their savings today? And you can quickly see that low-income households do not have much more savings today in nominal dollars than they had in 2019. So it's very clear low-income households are not in great shape at the moment. That's in sharp contrast to the top 20% of incomes you see to the right. The top 20% of incomes, according to the Consumer Expenditure Survey, they account for 40% of consumer spending. That means that high-income households really account for a very significant share of consumption. And look at high-income households' savings in the red bar today relative to where the green bar is. It's literally the case that high-income households have trillions of dollars more in savings than they had in 2019. That's why a very important tailwind to growth is that those households that are here to the right, they have continued to spend. And that's exactly how markets have traded. When you split consumption into luxury retailers, this is the stock price of luxury retailers in the green line, and discount retailers in the blue line, you could see that this gap just continues to widen, that high-end retailers continue to do well, and low-end retailers continue to, unfortunately, not do very well. So that's why a very important backdrop is indeed that there's a difference, especially when it comes to wealth. And just to complete, there's also a difference when it comes to wage growth. This chart shows you wage growth across the income distribution. The orange line shows you wage growth for low-income households. And historically, low-income households have had higher wage growth than high-income households. But check it out today. Now low-income households have lower wage growth than high-income households. And this is also contributing to the K-shaped situation. So not only is there a difference in K in wealth, but there's also a difference when it comes to wage growth. And finally, there's also a difference when it comes to inflation. This chart here shows you the New York Fed data for inflation for people at the bottom of the income distribution or people at the top of the income distribution. And people at the bottom of the income distribution, they spend more and a bigger share of their consumption on housing, on energy, and on food. And those are exactly components that have a higher inflation. And therefore, those parts of the population that are low income have, unfortunately, also not only have had a K-shaped situation for wealth or for wages, but also in terms of the inflation that they're facing. So yes, this backdrop of the K just getting longer and longer on both sides of the K is a very important feature of what's going on in the economy at the moment.
So we basically need rates to come down so that the middle lower tier can actually afford a home, because the housing market has been dismal for them because of higher interest rates.
Yes, exactly. Because the issue is exactly as you're saying, that when you have interest rates that are elevated, and elevated meaning in this case around 3-4%, where we are with the Fed funds rate, and that's where we've been now for quite some time, that of course means that anyone who has debt has higher debt servicing cost. And who is it that has debt? It is generally the households over here. So that's why if you would like to help the economy and like to help the housing market in particular, of course, lowering interest rates and lowering debt servicing costs for the households over here would be a very important first step. That's, of course, very challenging when inflation is high. Kevin Walsh is coming in at a situation where the market, as we speak, is pricing that the first Fed cut is now coming in December 2027. So this is also telling you that we are quite a distance away from Fed cuts. And that means that the challenge here with the K-shaped situation is likely going to continue because interest rates are not going to come down. It's going to be very difficult. Remember, Kevin Walsh is one voting member and there's 12 voting members. He's just one. But if the other 10 or 11 votes that interest rates should not go down, then there's a limit to what he and Stephen Rand, the other members argued for rate cuts, are going to do. So the bottom line to your point here is exactly when rates are higher for longer, it does have a more negative impact on those who have higher debt servicing costs, which happens to be those at the bottom of the income distribution.
And I want to pick your brain about the Fed, but I want to just ask you one last question about the consumer. And I want to ask you about the labor market, just excluding AI, because I want to talk about that later, what that's going to mean. But for now, the labor market, as I would characterize it, is it's cooling, but it's not collapsing. I happen to like, and I would like to know what you look at. My favorite indicator is just smoothing out a 3-month average of weekly jobless claims, because I get kind of frustrated with the non-farm payroll numbers because they're so inconsistent and they get revised so frequently. ADP is fine, but I don't know if it necessarily matches up to what is really going on. But what indicators, what stats do you look at as an indication for labor, and what are your thoughts about the labor market in general?
I look at exactly the ones you just listed exactly also because they are the top ones that everyone should be looking at. The very important issue about the labor market at the moment, let's say that we had a firm, you and I, and we had to go out and hire some people. Of course, when we think about the labor market, we should think about labor demand, meaning who can we find to do the work that we're looking for. But what's very important is also to think about labor supply. That's normally not super relevant for a conversation about what's going on in the economy and for the Fed and inflation. But because labor supply has changed so much with the change in immigration policies, that means that the labor supply is beginning to play a very important role. Here are some numbers that I therefore look at that are very critical for this discussion. So from the years 2022, 23, and 24, net immigration into the US was about 3 million people, according to the Congressional Budget Office. Today, according to the Congressional Budget Office, net immigration has declined from 3 million people for those years to now 500,000. Why is that important? Well, this is extremely important because it means that the break-even or the non-farm payrolls number that comes out that should be consistent with immigration and population growth and aging has now declined dramatically from historically the number of jobs we saw every month was around 200,000. Now Fed is writing working papers and blog posts saying that it's basically zero. That means that when we look at non-farm payrolls expectations for Friday next week, the consensus currently expects 59,000 jobs to be created in the month of April. Normally, you and I would have had a conversation for many years saying, oh, that's not very good. 59 or 60,000 jobs, it should be 200,000. But because the number of workers coming into the US has declined so much, that's actually a really good number because it's higher than zero, which is where the Federal Reserve currently tells us that the break-even employment growth rate is at the moment. So the bottom line is to your question here, I still think that there is a low firing rate and a low hiring rate, partly because of tariffs, partly because of uncertainty generally, also now because of AI and companies trying to figure out what's going on with their business planning. But what is critical also for what's been happening in the labor market is that we've had a very dramatic decline in the number of available workers. So as a result of that, we have also seen, therefore, a very significant decline in job growth because there's simply fewer people coming into the country looking for jobs. And that's a very important reason why the labor market has to be viewed with this in mind, namely that the labor supply has declined as dramatically as it has.
Do you think, and I don't want to get into politics at all, but do you think, though, that let's just say we have kind of a regime change, that all of a sudden that changes, the immigration situation changes, meaning like under the Trump administration, maybe this is kind of like a one-time event to try to get to where they want to get it to? I'm not sure I'm asking it the right way, but I'm just wondering how permanent this decline has been.
Yeah, this is a very, very important question. But the first, more procedural answer to that is that even if the Democrats do win the House and the Senate, we still have Trump as the president for the next 2 years. So there's a limit to what can change on this front for the next 2.5 years. So at least for the next 2.5, 3 years, it seems very unlikely that we'll have any change to this policy. Whether the Democrats will come in 2.5, 3 years if they win, or who knows who will win in 2.5 years, that's of
Sure.
course a different conversation. But at least for the foreseeable future, this is not going to change for the next several years. And I do think that this becomes important for us in markets, because the other issue associated with this is, remember, Pew Hispanic Center had looked at what sectors is it that unauthorized immigrants are working in. The 3 million number I mentioned earlier was both legal and illegal immigrants. But unauthorized immigrants work in agriculture, construction, hotels, and restaurants. And we're beginning to see wages go up in those sectors where labor is missing. So that's why the answer to your question is that the, of course, issue becomes that if we do have a quite significant continued curtailing of immigration, there is some potential risk that wage growth could begin to move higher. And this was actually the daily spark a little bit today, but if you begin to look at job switchers and people are staying in jobs, you're seeing a little bit of that. That's why next Friday, when the employment report comes out, is not only about job growth, but it's also important to see, are there sectors where the labor market is beginning to look a bit tighter because of this decline in labor supply in certain sectors.
So the GDP number has been coming down. The Atlanta Fed tracker has been coming down. Pre-war, we got as high as 5.3, I think. It was crazy. And now we're at 1.3. How worried should we be? And and then we'll get to the inflation question in a minute, because I want to come back to productivity as well. But like, so we are slowing. And is it all just because of the war, or is it something else that we should be concerned about?
Yeah, this is, of course, very, very important. And this is, of course, critical for the very near-term discussion of, well, if the Strait of Hormuz is closed for, say, another 6 months, well, how should we then think about what the implications are for, that's not our expectation at all, but if that were to be the case, what would that type of risk mean for GDP growth over the next several quarters? And to your point, this chart here shows you GDP growth in the second line. The expectation is that GDP growth will be a little bit weaker over the next 6-9 months. But once we get to the other side of that, and particularly as we get into the second half of this year and get into next year, the expectation is that GDP growth is going to come back to around 2%. So this is about 60 people who submit their numbers to Bloomberg. This is the median of their forecast that you're seeing to the right. So one way of answering your question is that at least at this point, it seems to be the case that the consensus or the market has the view that, hey, GDP growth and therefore earnings growth and therefore the broader economic picture is actually still going to be just fine. And the last point on this is, I know we'll talk about AI also in a minute, but the last point on this is to also have a look at what is the consensus expectation to the unemployment rate. And you can see here, interestingly enough, the expectation is that the unemployment rate is going to come down to 4.3. So it's not the case that people are expecting unemployment rate to go up because of AI or slowdown or anything else. It really is the case that the economy is just chugging along, and therefore, to the inflation point, that, of course, means that we need to pay attention to what's the forecast for inflation. And the forecast is just that inflation is going to continue to be a problem at least for another 12 months, which is exactly why the market is pricing that the first cut is only going to come in December 2027, because inflation is just not quite due yet. And as you can see here, it's still hanging around at levels for the next year, roughly around 3.5.
But it is nice to start to see rent prices come down, right? We've begun to see that, and if we get productivity, that should also help. But obviously oil can't be where it is, and all the the implications from higher oil. Why do you see? Why do you think the people that were that are on this and interviewed for this slide, why do you think we see the reacceleration? Because the war ends and we can get back to the momentum that we were seeing pre-war, or is it what do you think the reason is?
Yes, I think it is exactly those two things, namely that people expect the war to end, and then we're back to talking about the long-term thematic things. As investors, we should always be thinking in themes. What are the thematic items that we should be trying to ride the wave of? Where is it that things are moving? And you can see AI spending is still going to be a major boost to growth. Industrial renaissance, it's a bit more drawn out industrial renaissance, but it started with the CHIPS Act under Biden in 2022, where he said, I need to have semiconductors come back to the US. Now Trump is saying he doesn't want to have prescription drugs produced outside the US, so that's why that's also coming back. And defense, for obvious reasons, is also having a tailwind. And the one big beautiful bill is a more near-term, meaning next 6-9 months tailwind, but it's still also important enough because this is also going to be a contribution. So the short answer to your question, Steph, I think that even though the headwinds from the Middle East and the uncertainty and oil prices going up, well, most people have the expectation, and to your question here, most people seem to have the expectation also that it is going to end at some point. And if
Yeah.
that's the case, markets continue to go up. And at the same time, if that's the case, GDP growth should also continue to do well. And then we are back to talking about the unusual factors that are really, really pushing the US economic outlook forward. And note, very importantly, none of these three things here are present in Europe. We do not have an AI boom in Europe. We do not have an industrial renaissance in Europe. And we definitely do not have the one big beautiful bill in Europe. Likewise, we don't have it in Japan, Australia, Canada. This is very unique. So normally my job is easy. I just say the US is good, Europe is good, the US is bad, Europe is bad. But at the moment, there's a very significant divergence where Europe is, first of all, harder hit by higher oil prices because Europe is a net oil importer, US is a net oil exporter. And finally, those three things here also argue for this, if you will, K-shaped situation where Europe is just going to be under more pressure and the US is going to have more tailwind. So I think it's the expectation, two things, that the war will soon be over. That's what Trump continues to say. And I think that's correct. And the other thing that is that, well, we have some other very unique forces that are driving growth in the US that just are likely to continue.
And one big beautiful bill could add as much as 80 basis points to
That's
GDP,
exactly
do you
right.
think?
That's
Okay.
exactly right. That's what the Congressional Budget Office has been saying. There's some estimates, and the reason why that's being debated among some people is that if you give $100 to households, how much of that will they spend? Will they spend $50? Will they spend $20? Or will they spend $100? That depends a little bit on whether households, if they are in distress, they generally tend to spend less. If households are feeling good, they tend to spend more. There's also a difference between high-income households may not spend that much of $100, whereas low-income households may spend a lot more. So that's why the so-called marginal propensity to consume, meaning how much are consumers going to spend, there's a debate about how much of that is going to actually end up in actual spending. But the short answer to your question is, yes, it is the case that the CBO is estimating that this is going to have a fairly meaningful impact on GDP over the next several quarters.
And do you think that the manufacturing ISMs then can stay comfortably above 50? I mean, we've been above 50 for 3 months in a row now, which I don't think we've seen since 2022. I could be wrong on the day, but I just think that that could be very powerful. And not a lot of people are talking about that. I don't think.
I agree, but I think that that is driven in part by the very significant AI data center
Yeah.
boom. And I think it's also driven by some very unique forces that politicians in the US, I mean, Trump, Biden, for the last several years have basically said, we need to have something produced in the US rather than having it produced in Taiwan or in China or prescription drugs in India or other things in Europe. And that is basically almost a global trend, but it's particularly pronounced in the US, where there are just certain strategic sectors, in defense, of course, is the most obvious one, where we got to produce this stuff at home. The Europeans are in many ways trying to do the same thing, get the defense sector really off the ground by saying we got to produce these things. And remember, this is just simply manufacturing. So not that it's simple, but it is manufacturing. And therefore, to your point, ISM, which is an attempt to try to describe what's going on in the manufacturing sector, is exactly an attempt to try to say, well, you know what, ISM and manufacturing is likely going to continue to have tailwinds because of these unique forces coming both from data centers and from this very, very strong political desire to bring back production to home countries.
And it takes a long time to build manufacturing plants, a
Which
couple
is
of
why it's
years,
drawn
right?
out over a much longer period because we can remember prescription drugs. Some prescription drugs that we sell in the US, like 95% come from India or China. We can't overnight create that capacity in the US. But of course, Trump's agenda is to make America great again. And one different way of saying that is make basically the manufacturing sector great again. And if that's the case, we should expect, and not only because of that, but because of this political willingness to bring back production of manufacturing, that should bring back, therefore, the construction of manufacturing plants. And therefore, to your point, that should bring back also some tailwinds to the ISM.
Okay, so that's very, very interesting. I mean, as a portfolio manager that has a lot of this stuff in my portfolio, I'm happy to hear it for sure. Let's switch to the Fed. Warsh is going to get confirmed. It seems to be. I'm a little worried that, to your point of the Fed not cutting immediately like President Trump wants, we're gonna have now round two of the Powell-Trump, feud, if you will, via Truth Social. I hope that's not the case. I don't, who knows? But dual mandate is the dual mandate. And if we think that labor market is cooling, not collapsing, but inflation's going to stay, a little high, stubbornly high, how do we get past the friction between the Fed chair and the president and really what should be done? And then secondly, like, is Warsh going to be able to corral the 12 voting members? Because I think that's like a really hard job, probably harder than managing Trump, to be honest.
Absolutely. I mean, that is exactly what you are highlighting here is exactly the whole issue, namely that there are, let's just say it the simplest way, there are 12 voting members. In the
Yeah.
last meeting, one of these voting members, Steve Moran, argued rates should go down. The other voting members said, no, they should not. They have to stay flat. The market is pricing. The first Fed cut now comes in December 2027. So the starting point is the market thinks rates are not going to go down, and 11 of the 12 voting members say rates are not going to go down. So let's now think about it. Okay, so maybe we will now get, and some talk about that he might even come sooner, but we'll definitely get for the June meeting that Kevin Walsh is coming in, and then some other small things. But let's say that then Steve Moran stays on the committee. But then we have 2 out of 12 members that think that interest rates should go down. But we still have 10 members saying interest rates should not be going down. So
Right.
that opens up a very, very complex discussion about, well, what about these 10 members? When are they leaving? Are they leaving? Remember, the normal duration and tenure of an FOMC member is 14 years, exactly to avoid such political interference in having quickly swings among what the FOMC members are thinking. So you're right. It is exactly what is Kevin Walsh going to do? Is he going to come in and try to convince the other 10 members that we got to cut rates, we got to cut rates? Of course, the economic data will be what the economic data is, but that exercise, at least where we stand right now, is going to be very, very challenging. And I think that's why markets are pricing at the moment that the next Fed cut is only going to come way, way into next year. So that's why, exactly as you're highlighting, this debate about what will he say in speeches, what will
Yeah.
he say in press conferences. There's also discussion about what will he do with the Fed staff. He can change the Fed staff if he wants to. That's also a very important thing here, because remember, the Fed staff writes the note that goes into the meeting, and that note has a recommendation. Should rates go up? Should rates go down? And so that's why a lot of different things are going to become clearer over the next several months. But reading his first speeches and his first press conference in June, which I know is a little bit 6 weeks away here, but it still is become very important for understanding the answer to your question, namely, are they going in the dual mandate to put more weight on inflation, or are they going to put more weight on the labor market?
Should we care about what they do with the balance sheet?
Um, no. I know it is getting so much attention, and
I
Kevin Walsh has
know.
had very strong opinions about that he wants a
Yes.
smaller balance sheet, and that's possible. For the average investment decision that I think about, this is like just like a peanut. Some people would think this is extremely important for its own reasons, but if I think about, should I buy private credit, public credit, should I buy low quality, high quality private credit, those things really don't matter much for the broader asset allocation decision that we're all making.
Yeah, I know it does get a lot of attention, and I'm not really sure. Even I need to understand it. I mean, I do understand it, but it just gets a lot more attention than I would think. But I don't know. Does he have any other tools? Does Warsh have any other tools? I mean, he's got
Yeah,
rates
well,
on
the
the
issue
balance
is
sheet.
you're absolutely right. There are 2 tools. Well, there is, in theory, there are 3 tools: forward guidance, interest rates, and the
Oh,
balance sheet. But he doesn't
yeah.
like forward guidance, so he
Mhm.
doesn't want to give any guidance about what's happening in the future. So that's why he ends up with interest rates, and he's now saying he doesn't want to use the balance sheet. So that's why it is
Yeah.
really ultimately all about interest rates, and that's why a lot of this ends up being this. How well do they work together? Does it matter how all this was put together, who the other candidates are, who they
Yeah.
voted for, Lisa Cook? It's just really complex in many different ways. But the bottom line still is where we stand right now, then it seems very clear that there is a very significant majority of people saying that interest rates should not be going down. And again, that's what markets currently are pricing, namely the interest rates are not going down.
I, for one, hope that he actually restricts any Fed member from talking every other day to the public. I know Powell what he was doing. He wanted to get more communication and for people to understand what was going on and the method behind the madness and all that. But in so many differing opinions, it was so confusing and jarring to the markets. Do
Yeah,
you think he's
and
going to be able
also
to do that?
I don't think he will do that, but I agree that it is a lot of communication. As you know, there is a long, long debate in central bank world about should we just be super transparent? Should we show videos directly live from the FOMC meeting, and everyone should be there accountable for what they're saying? Or are there some balances that we need to take into account that, hey, then it would not be an honest discussion, it would be much more scripted? I mean, so it is a very important constant debate, not only for the Fed, also for the ECB and the Bank of Japan. How do we
Sure.
design these policies, these institutions in a way where we both have something that you and I and us on this call can find helpful for our investment decisions, but also where we don't drown in footnotes in Greek letters and complex arguments that may end up being just overcomplicating things relative to what we need to know.
Yeah, no, I know. Just want someone that's simple, can explain, but not too much. We talked about the economy and how you feel good. And post, even once hopefully we get through the war. Earnings. Is that something that, I mean, seems to me over the last couple of weeks, you've seen earnings revisions higher. I've seen as high as 16% for this year. I know Ed Yardeni is using 17, which wow. And we're so far running at about 25%, but it's only a small few companies that have reported so far. Where do you see earnings kind of coming in? And then at the same time, the multiple has come down. I mean, the markets are not cheap per se, but we've gone from 23 times to 19 times. So I like that combination. What says you?
I would say that if you look at exactly to your point here, this is forward 12 months EPS for the S&P 500.
Wow.
I mean, when people just as you just highlighted this, I'm just showing you in level terms. So you mentioned the growth rate, but as people highlight, if I worry about is the economy slowing down, is the economy not slowing down, I'm looking at this and saying, well, if anything, it actually looks like the economy is getting better.
Yeah.
So let's just agree that the E in the PE ratio is actually doing quite well. And to the question, why is that the case? I keep coming back to, well, that's the case because we have some really strong engines of growth. So that means that we have some reasons to be optimistic. And that, broadly speaking, also, of course, is helpful for the growth outlook. As we all know, and as you and I sometimes talk about, there are, of course, some important issues in terms of the composition of that earnings growth. And some of that composition of that earnings growth is because of tech. And there we have certainly seen a very significant adjustment because tech has made up such a significant share of growth for the last several years in earnings, in market cap, in profitability, in profit margins. But this chart here is exactly this issue that continues to be the topic du jour, namely this is the forward PE ratio. The orange line is for the S&P, and the green line is for only IT, meaning the 10 biggest companies, meaning basically think of the green line as the Magnificent Seven. And there was a nice premium for a very long period where AI and technology was trading at much more elevated levels. But that premium basically disappeared as the E went up. So if we all have not forgotten, but I mean, the PE ratio for NVIDIA today is like 22, 23. So there's a lot here that have just adjusted as the E in the technology sector has gone up to these incredibly high levels that makes it harder and harder for these companies to generate these phenomenal growth rates that they've had for a lot of years. So the short answer to your question is the main problem I still have even to this day with S&P 500 is that it still ends up being an AI story because the 10 biggest stocks make up 40% of the index. And by the way, in credit, now most of this issuance is coming also from hyperscalers, which is also an AI story. So I have AI in my 60-40 portfolio, I have AI in my equity story. I have also now AI suddenly in my bond portfolio. And if I have venture capital, also venture capital is also like 70-80% AI. So suddenly I wake up with AI everywhere in my pie chart. And yes, AI, I do think it will be revolutionary, but it does become very important to then begin to think about that I have one factor that I'm exposed to everywhere, and therefore think about that in this context of, okay, but what are then the upside risk, the downside risk? Are there other factors that I need to be considering rather than just having AI in my equity portfolio, in my public IG portfolio, and in my venture capital portfolio? So I do think that the S&P has upside in the sense that earnings are looking great, the economy is looking great, but the concentration issue continues to bother me significantly because that means that if I just take $100 and buy the S&P 500, I'm not getting 500 different stocks. I'm just getting significant overexposure to one factor, namely AI at the moment. And that's the question whether that is the greatest decision to make at this point.
I was on CNBC this morning. I said that kind of what you just said, but you said it more eloquently than I did. But that earnings so far, 27% of the companies in the S&P 500 have reported. So we were still very early on, but the growth rate is 25%. But it is coming from semiconductors, energy, and industrials. So it goes right to your point of that all has a common theme in terms of AI and the AI food chain, because it's obviously AI, it's data centers, it's grid, it's power. All of those industries are going to they have been benefiting, and I don't know if all of those four industries will actually surpass technology weighting. I mean, I don't see it, right? I mean, energy's 3% of the S&P 500.
It's been a great run. I mean, tech has done phenomenally, and I do expect that significant parts of tech will continue to do well.
Yeah.
But the page one in everyone's finance textbook says you have to be diversified. And diversified historically was the 60-40 portfolio. It was very brilliant. When stocks went up, well, then bond prices would go down. And when bond prices go up, then stock prices normally would go down. So there was like a natural hedge from having a 60-40 portfolio. But today, we need to think much more holistically about, well, what is inside that 60? What's inside that 40? What are the other things that are the options that I can invest in that can be opportunities to look at? now that we're having a situation where it just happens to be one factor, which happens to be AI, but one factor that now plays such a significant role in basically all parts of my portfolio.
Yeah. Before we get to AI, because I definitely want to, and I don't want to run out of time, but I do want to ask you about the bond market and yields. They've been higher. Is that because of inflation concerns? What's behind the move? And by the way, I feel like in the last year, like I know yields are moving higher, but the 10-year really hasn't moved dramatically year over year, which is also kind of interesting to me.
Yeah, this is very important. So if we just concluded that because the economy is good and inflation therefore is higher, that means that short rates will probably be higher.
Yeah.
Again, the market is pricing the first cut only by late next year. Now let's look exactly at the long end of the curve. The key driver, of course, of the long end of the curve is, as we all know very well, the fiscal situation for the US. This chart shows you debt to GDP, and the chart starts over here in 1776. And as you can see, we're walking into a period where debt to GDP has literally never been higher than it is at the moment.
Mhm.
This opens up a discussion around, okay, so what does the Treasury do in terms of where on the yield curve should they issue government debt? Should it issue 2-year paper, 5-year paper, 10-year paper, 30-year paper? And you can quickly see that measured in billions of dollars, most of the issuance in the last few years have been in the front end of the yield curve. Most of the issuance is not in the long end of the yield curve. Why doesn't Scott Bessent and the Treasury go out and issue, say, $1 trillion in the long end? Because the risk is that there will not be enough demand. Because the main buyer in the long end are people who have long-term liabilities that are buying long-term assets. And those who are buying long-term assets are not only buying 30-year treasuries, they're now also buying privately issued long-term assets in data centers, in energy transition, in climate, in infrastructure. So that's why there's just more and more pressure on long-term sales of US treasuries, because there's just more and more competition from private issuers of long-duration assets. And you can see this also when you look at the flows from households. This is ETF flows from households, and you can see that the ETF flow from households shows that households have a willingness to put money into the front end, but there's less and less willingness among households to put money into the long end. And that's why you're beginning to see now a spread between where 10-year rates are and where they should be. The green line shows you the 24 months Fed fund futures, so that tells you something about Fed expectations. And the orange line shows you the 10-year rate. And if you go back in history, there's been a very close connection between what are Fed expectations and what are 10-year rates. So when the Fed was expected to hike, 10-year rates went up. When the Fed was expected to cut, well, 10-year rates would go down. But in the last 18 months or so, we've started to really see a premium emerge. 10-year rate today should not be a 4.3. If the historical relationship had held, 10-year rates should be closer to 3.8. So that's a different way of saying that there's a premium beginning to show up, that 10-year rates haven't really gone down as much as they should. And of course, the reason for that is, of course, that the fiscal situation, not only in the US, but globally, is just continuously getting worse and worse. The US long rates have gone up. German long rates have gone up. And of course, a major issue in the macro will continue to be that Japanese rates have also gone up. So sorry, this was a very long answer to your question, but the bottom line is that long rates are unfortunately now under some pressure, on the meaning upside pressure, because there's just a fiscal situation that's beginning to show up more and more in markets, and therefore raising the risk that maybe it's going to be harder to sell long-term government debt, especially with the volumes of long-term government debt that are coming through that chart when debt levels go up so much.
I just feel like, Torsten, we're going to be talking about this for decades. Like, I feel like my 19-year-old is going to have to deal with this, not
I
us, you
agree.
know? And that's
Because
scary.
this is the CBO's forecast. This is not the Apollo forecast. This is not Hightower forecast. This is the Congressional Budget Office. This is the authority over fiscal forecast. And they are telling you and me and everyone in markets that we are going into a situation that just looks what Jay Powell describes as unsustainable.
Ugh.
And that's exactly why this topic is just not going away.
I know, it's but before Liberation Day, that was the number one question when I would go visit advisors. Number one question from advisors and from clients, and there was real concern. And it comes up still now, but there's obviously we have a few other things that we've been dealing with this year. I do want to get to these two. Sorry, you've done such great work on AI, so I want to talk about like your thoughts, AI adoption in the US versus Europe. And I'm fascinated that you say that Europe does not have an AI boom. Then also the labor market. You wrote a great piece on how it's going to reshape the labor market versus replace. And maybe we could talk some sectors that benefit and some that are maybe a little more disadvantaged. And then we can get if I can get one last one in, we did have a question about private credit, surprisingly.
Okay. Yeah, so the answer is that the AI revolution is absolutely real, and it is going to have it's already having a dramatic impact on your life, my life, everyone's lives.
Yeah.
And what is the key takeaway from what's going on it is that there are some tasks of your job and my job that have now become easier. In other words, you and I do like 20, 30 things every day. Some of these things can now be done easier. We can sound smarter when we look at things. We can do things with data. We can ask questions on the go. We can do with Claude, Gemini, ChatGPT. We can do a lot of different things that we couldn't do before. But what also is very important is that you and I can also begin to open a new business much, much faster. And that is exactly what is visible in the data that you see here. This chart shows you the weekly data for how many businesses are opened in the US economy at the moment. And you can literally see 3 weeks ago, this was the highest number of business applications ever in
Wow.
US history. So this is telling you that this is not only about AI replacing you, me, lawyers, consultants, I mean, everyone in the whatever accounting world, all the different areas that we normally think about. But it's actually also about that it's become a lot easier to open a new business. And that's showing up now in a significant increase in the number of new businesses that are created. And therefore, some of them are probably going to be successful. They may not need the same amount of workers, but they will probably need some workers, which also therefore comes with the conclusion that therefore we should actually also expect to see some increase in employment. And what's very important is that this is going to come hand in hand with an increase in productivity. This chart here shows you what is output per hour. So there's a different way of saying what is productivity per US worker. And you can see when the computer came along, productivity went up. When the internet came along, productivity went up. And now we are down here at the bottom. And AI is not quite at the levels that we saw in the 2000s and after the 1990s boom and in the 1980s. But it's still very clear that the trend is our friend, and we are beginning to see the effects of this begin to show up. So we should expect to see, therefore, that AI is going to have a revolutionary impact on productivity and ultimately also on the economy. Where the issue becomes important is what you're exactly highlighting about the labor market. And one thing that's very important in this discussion is that there's a lot of debate about young people. What is the fact of some statements? What is the case? Can they find a job? Can they not find a job? Are they going to be replaced by a computer, by Claude? Well, let's just look at the data, because there's a lot of things we can talk about. The green line shows you the unemployment rate for people who've just graduated college, 20 to 24-year-olds. People
Wow.
often send me just the green line and say, look, let's forget the last three numbers you can see in the chart here. But people send me the green line and say, hey, the unemployment rate is going up. Young people can't find a job. And the answer is, it's going up for everyone. Other demographics also cannot find a job. It's gone up for the orange line also. So another way of saying that is that there really is no evidence that it's harder for young people to find a job. The hiring rate is low for everyone. The firing rate is low for everyone. But if you look at this chart here, it's very clear that young people are exactly experiencing the same trajectory as everyone else. So yes, if the green line does start to deviate over the next 6-12 months dramatically and go up a lot more than the orange line, then I will begin to worry. But the bottom line here still is that it is a much more complex discussion rather than just saying a robot can come and take my job. And the last example of this is also there's a lot of discussion about software. This
Yeah.
chart here shows you employment in the software sector, coders, computer science. Of course, a lot of folks have been losing their jobs. Specifically, about 200,000 people have lost their jobs over the last several years. We were at 3.7 million people worked in software before. Now 3.5 million people work in software. But the bottom line is those 200,000 could also have lost their jobs because the Fed hiked rates. They could also have lost their jobs because restrictions on immigration have been tightened significantly. So if I compare those numbers with the total number of people who we get hired in the US economy every year, which is 63 million, that's like peanuts. 38 million people quit their jobs every year. 21 million people, they are fired every year. 200,000 people in software is like a really small number, even in call centers, which also gets attention. So job growth in call centers is at the moment minus 100,000. Yeah, it's unfortunate, but at the same time, 100,000 out of 60 million people who change jobs every year, it really is relatively small numbers. So the bottom line is, I view the outlook for what's going on in the economy at the moment, that this issue of what's going on with business formation is really the most important. This is weekly data you can get on the census homepage. It really tells you how incredibly dynamic the US economy is, and therefore how many new businesses are created. So I'm actually quite bullish that AI will both raise productivity and also raise employment.
Oh, okay. That is so out of consensus. I can't, and that's the number two question I get, by the way, about AI and the labor market. And when I talk positively about the labor market, they look at me like I have seven heads or something. So, which I
Exactly.
understand. I mean,
Same,
because we
same
just don't
here.
know. I think people forgot that there were jobs that were created when the internet came out. People thought everyone was going to lose a job. And well, we got mobile phones, we got apps, we got so many different jobs that we didn't even know existed. So there's a chance that we don't know even some jobs that will be created because of it.
And that's why we take one data point at a time, and we do again
Yeah.
next Friday. We get the employment report again, and you and I will talk and discuss, was it good, was it bad? So far, the expectation is it's again about 60,000. That's a pretty
Yeah.
good number when it should be zero. So yes, of course, let's talk about it. Let's look at it over the next several months and quarters ahead. But at this point, it's just very clear that the labor market continues to do very well.
Do you have a strong opinion on which sectors benefit the most from AI?
But the challenge with that discussion is that it becomes very specific to which sectors are exactly adopting what, and will the
Yeah.
incumbents be successful adopting things, or will it be outcompeted? But what I think is the main conclusion from this discussion, and then we can talk about individual sectors, but I think the highest level takeaway is that let's just agree. You and I could literally tomorrow do things that we couldn't do 12 months ago in terms of opening a new business. So if you now suddenly have in consulting, in law firms, paralegals, in finance, that suddenly it's become a lot easier to open a business, the entry costs of entering any industry have just collapsed dramatically because now things can be done much, much faster. Well, that must mean that the competitive pressures on a lot of sectors in the knowledge world is going to be even more intense. And as a consumer, that's actually good news because that means that more people find jobs, more people compete with the banks, more people compete with lawyers, more people compete with consultants, because now I can find small ways of doing niche parts of knowledge work with a group of friends, and we can be wildly successful. So there will be more and more competition, which ultimately means, of course, also lower prices, but also ultimately means that employment will probably go from some of the incumbent institutions that have not been under that competitive pressure, and people will break out and say, why don't you and I open a shop where we can begin to sell this knowledge using these tools, and therefore we will get a very dynamic economy. So yes, I know from an overall stress level, this maybe is not healthy from a broader perspective, but it's definitely healthy in the sense that we do get more competitive pressures, and therefore those businesses that have been sitting on bigger power and the incumbents in many areas are now experiencing more pressure than ever.
Well, you mentioned the banks, but this is one of the reasons why Jamie Dimon is spending $20 billion on technology a year.
Yeah,
I mean,
because the payments system is under pressure globally. You have savings under pressure globally. You have loan giving under pressure globally. Financial markets under pressure globally. So
yeah.
yes, there's a certain number of very good examples exactly in financial services that exactly are examples of what you're mentioning.
Why does Europe not have an AI cycle?
Well, this is a very long and very complex discussion for Europe, but the short answer is that they have very, very complicated rules for hiring and firing. If you
Oh,
want to
okay.
hire or fire anyone, it is unfortunately still to this day, in particular in France, but also in Germany, it is extraordinarily complicated to hire new workers. It's extraordinarily complicated to get rid of existing workers. And I know this may sound like why we're talking about that, but it just happens to be really important. If you and I wanted to start a business, or anyone on this call wanted to start a business, we know how easy you go out and find someone. If you're willing to pay them, they could come over basically tomorrow. Maybe it takes a little bit longer, but bottom line is you can get your workers when you need it. But that's just really, really the core of the matter. OECD has written tons of reports about this issue, that a flexible labor market, making it easy to hire and fire and making labor come and go very easily, is absolutely what drives innovation really more than anything else. Number two on that list, very close, is financing. We do not have financial markets that are as developed. Banking sector is very, very prominent in Europe. Europe is a bank-based financial system. US is a market-based financial system. And when you have a bank-based financial system, you don't have the same diversity in sources of financing that we have in the US. In the US, you can go to private equity, private credit, you can go to venture capital, you go to your local bank, you go to community bank, you go to regional bank, you go many different places if you want to get financing. In Europe, very simply speaking, you can really only go to a major bank. There is really no much significant venture capital or in any significant, at least not the US magnitude, private equity or private credit or even bond markets are also smaller. So the short answer is two things. The labor market is just not very flexible. And the second thing is that the types of financing and the financial system is unfortunately not quite developed enough, at least not compared to what we have in the US.
And it's kind of sad, to be honest, to hear it, because
It's
this
very
is
unfair. I mean, there's a number of, you're
right.
right.
It's a chance
It
for
is.
Europe to kind of get themselves, a little bit
The,
better, right? I
the
mean,
upbeat way of yeah, the upbeat way is to say that they have a lot of potential. The downbeat way is to say that there are still some politicians in the 27 different European countries who need to get
yeah,
their act together and say, hey, we need to do what's best for all of us and not
yeah.
have this inherent complicated, oh, we do what's best in our country, we're not doing what's best in that other country, which makes it very, very difficult to harmonize and makes the rules more consistent and moving in the right direction. But it is something that's moving, but it's unfortunately moving very slowly to your point.
Yeah. No, and honestly, I mean, people ask me, where I would invest around the world, and Europe is definitely not one of them. And I might have missed last year's move in Europe, but I think with all the concerns, to energy, and then now this, it's like it even gives me more confidence, or kind of just a little bit more disappointing that it's not going to be the opportunity, and that there's other places. I'm a big fan of Brazil, but there's a lot of places elsewhere that are driving innovation as well. So let's end with private credit, because I've got to get to Susan's question. What is going on with private credit? How worried are you? And I mean, I don't think it's systemic, but we would love to get your opinion.
Yeah, so let's look at it and let's look at what's been going on in credit markets and where we are at the moment.
Yeah.
One way to look at that is to start out by looking at default rates. Default rates tell us something about, are companies succeeding? Are they not succeeding? Are default rates going up? Are default rates going down? What is the overall state of credit at the moment? This chart here shows you default rates in loans in the green line, and the blue line shows you the default rate for high yield. This is for public markets, but the index for public markets and for private markets is not wildly different. There are some smaller differences with a little bit more weight to tech and software in private markets, but broadly speaking, it is roughly speaking the same basket. And as you can see, loans default rates have been going down, high yield default rates have been going down. Even if you begin to widen it out and ask, well, what about distressed exchanges? So this is the levered loan default rate. The green line, again, is just the default rate. But now the orange line is default plus distressed exchanges. A distressed exchange is that if I borrow $100 from you, Steph, I come back 2 years later and say, sorry, I can't pay you back. You can then decide to say, hey, Torsten, I can see you're in distress. Why don't you instead give me some equity in your firm? Why don't we instead extend the maturity of the loan? Why don't we lower the interest rate on the loan? You can do a distressed exchange with me, and once we do that, as you can see in the orange line, that was very pronounced, then you will instead have another part of my capital structure changed relative to where it was before. And you can see, importantly, the distressed exchanges still is quite elevated relative to where defaults are, but it's a lot better than where it was 12 months ago. So another good news is that it's not only the case that default rates are going down, but distressed exchanges are also going down. And finally, LMEs, liability management exercises, have also been going down more recently, also telling you that the business cycle is gradually getting better. So what is it that's going on in private credit? Why is it, despite these numbers I just showed you, that the economy is getting better, distressed exchanges is going down, you have default rates going down, you have LMEs going down? Well, what's going on is that there are some sectors that are not doing particularly well at the moment. And those sectors are, of course, those who have a lot of leverage. Because when interest rates are higher for longer, as we started out talking about here, squaring the circle in our conversation, that means, of course, that the cost of capital will also stay higher for longer. And there are some sectors, healthcare, software, enterprise software, where you have that leverage ratios are high and coverage ratios are very low. Remember, coverage ratio, of course, measures my ability to service my debt. So that's my earnings divided by my debt servicing cost. But as you can see here, the bottom line is that there are some sectors that have been vulnerable, and those are exactly the sectors in private credit that have been in challenges. That's why, as you see at the moment, the software part of the private credit spectrum has continued to face headwinds, not only because interest rates are higher for longer, but also because of the AI disruption risk. That's why the yield level in software now is very elevated on loans. This chart here shows you the yield level on average leverage loans. That's about 8.8. But look at the yield level on software is 12. It's a dramatic difference, 3 percentage points. Normally, that's only trading at 1 percentage point. So this is also telling you that the market is still asking questions about software and what's going on in the software sector more broadly, simply because that yield spread that you see here still continues to be very wide. It's not the case that the orange line is going down and people are stepping in and saying, wow, great, 12% is a great entering point for buying loans in software. Instead, it continues to chuck along sideways because there is all this uncertainty. So the bottom line to your question is that there are some issues in credit, and in particular in private credit, there are some issues, especially lower rated private credit, such as software that generally has, again, lower ratings, higher leverage, lower coverage ratios. But the vast majority of private credit, especially high quality investment grade private credit, continues to be in good shape, just like other investment grades. So it really is a spectrum, and that's becoming clear, namely that there's a shakeout between what are different private credit managers actually doing. Do you invest in high quality investment grade or high quality companies, large cap, first lien, senior secured, or do you invest in companies that have weak earnings, weak fundamentals, weak cash flows, weak revenue? And if that's the case, of course, the spread is wider, but of course, there's exactly also more risk, partly when interest rates are higher, but also when the AI disruption risk is as significant as it is at the moment. So the short answer is some parts of private credit, namely those areas that have to do with software and tech, some parts of life sciences, healthcare, they have been facing headwinds, but the rest of the private credit world continues, in my opinion, to do just fine.
Yeah, I mean, I feel like there are some bad actors that we've had, and there are some signs of stress, particularly in software. But for the most part, I mean, private equity companies are very diversified, so it's not a big part of their book to begin with, right?
Well, there are some that are specialized in these sectors, but that's certainly the biggest part of everything private credit, and certainly what we do here at Apollo, where we are, of course, mainly invested. 97% of what's on Athene's balance sheet is investment grade credit. So, from the bigger perspective, what really is becoming clear is the homework that we at Hightower and at Apollo and everywhere else, we have to ask, what are you actually doing with the money that I'm giving you? What is your strategy? And that is exactly becoming more and more clear that the shakeout that is likely going to come along with this, that there was some that just took too much risk.
Well, Torsten, this was great. I could talk to you for hours on end, and I learned something. I took a lot of good notes, and I'm sure my advisors and their clients were learning a lot as well. So I really appreciate your time. I'm sorry we went a little overtime. I thought we were only going to go for about 40 minutes. Again, like last time, we almost took the entire hour. So I really, really appreciate your time, and
My
thank you so
pleasure.
much.
Thank you, Steph.
I'll see you in the green room.
Absolutely.
Okay,
Cheers.
take care.